Dear viewers, welcome to Fundamentals, a platform to understand your fund tenets. Here we bring to you the minds behind your fund. Today we are going to discuss a fund which pioneered a category so huge that today it has an AUM of more than 1.9 lakh crore. The category I am discussing about is Balanced Advantage Fund, and the fund under consideration is ICICI Balanced Advantage Fund. This fund has an AUM of close to 43,000 crore and has a trending return of 10 to 12% over last 5 years, 7 years, 10 years, and since inception. This is a dynamic asset allocation fund with an equity exposure of close to 40% as we speak. We have with us Mr. Ihab Dalwai, who has been co-managing this fund since 2018. Hi Ihab, welcome to Fundamentals.
Thank you for having me, Harsh.
So, Ihab, just to set the context and tone of our conversation, if you may please help us understand what is the investment style and approach with respect to balanced advantage fund.
Yeah. So broadly, I'll just start off with how I generally look about or approach investing. So what I try to do is that I try to identify sectors or stocks or segments in the market which are currently going through some stress or some pain, but the long-term fundamentals are intact. And that's when I feel that there are some price distortions and there's a gap between the price and the value of the business. And that's when I look to buy or build positions for the sector of stocks in a portfolio. So you can classify it as a counter-cyclical style for cyclical sectors, and that's the approach I use. So talking about the fund, so I co-manage this fund along with Rajat Chandak. He's the lead fund manager for it as well. So his style is more aligned to the growth style of investing, where he tries to identify market share gainers. He tries to identify sectors or segments of the market which have a good long-term growth potential. So when we both look at sectors and stocks, what I've seen uh, over the last 5 years is that we try to bring the best of the ideas from both styles of investing into this fund. So that's how the portfolio also, if you look at, it'll have high conviction ideas from my style of investing, and it'll have high conviction ideas from his style of investing as well. So that's how broadly the stock selection or the equity weightages are built. But the percentage of equity weightage is model driven. So it's dynamically determined in terms of what equity level should the fund have.
So, Ihab, you mentioned that there is a proprietary model which decides how much equity should this fund have. Now, what are the key variables to that model? If you can help us understand that.
Yeah, sure. So it's a valuation driven counter cyclical model, and what we use is a price to book multiple in terms of determining the net equity level. By counter cyclical, what I mean is that as price to book and goes up for the market, as market goes up, the net equity level for the fund goes down. So it's a counter cyclical approach. It's not a momentum. It's not a pro-cyclical model. So that's the main key variable in terms of identifying the net equity level. But over the years, we've assigned associated or ancillary indicators as well to the main core valuation indicator. But there we try to identify, because debt is also an asset class which you can invest in this fund. We try to identify the attractiveness of debt versus equity in a kind of an yield gap framework. We have a bit of other indicators as well, but they are not major indicators. I would say 80 to 90% of the net equity level is determined by the valuation model.
Got it. And you were mentioning, and at the beginning, I was also mentioning that your fund is a dynamic asset allocation fund. Now, when we look at hybrid funds, there are dynamic and there are static asset allocation funds. And coincidentally, in ICICI Prudential, you have both the funds and both are doing quite well. If I have to understand more on the dynamic side of asset allocation, how has this category been relative to other categories? And can you give us some instances where, because of dynamic asset allocation, this fund would have created some alpha?
Yeah, sure. See, what I strongly believe is a dynamic asset allocation is I feel it's a superior model to a static model. One is because the returns which equities generate, they're not linear returns, they're not like fixed returns. There is obviously volatility in the returns, in the ultimate returns which we generate. And to harness returns out of the volatility, I think dynamic is a better way of managing a hybrid category is what I feel. And what we have seen also, there are instances in like there would be instances of like 1 year or 1.5 years where market has not ended up giving any return, but it is because of the dynamic way in which we've managed the balance advantage fund. We've been able to generate returns in almost a zero return market environment as well. In case a static fund wouldn't have been able to generate that, obviously the debt portion would have generated some return, but because of the volatility, because market would have gone up and down in that period of 1 year, the end result is that it's a zero return period. But because of the volatility, we were able to generate returns. Uh, and that's what I feel, that a dynamic asset allocated the model is superior because of the volatility in the asset class which it is.
Got it. So you mean to say that you take advantage of the volatility rather than being impacted by it on the negative side. Now,
Exactly. Yeah.
now this brings me to the next question. So, which investment sector or what investor segment is this fund intended for? And as an investor, should I look at this fund as an absolute return fund or a relative return fund?
See, if you look at the risk category as well, it's a low risk category fund, because as market goes expensive, the equity exposure for the fund reduces. And as market gets cheap, the fund will be highest allocated to equities. So on a risk parameter also, I feel that it's a low risk fund. And in terms of a lump sum or an SIP concept as well, I think anyone has any surplus savings any point of time, they can look to invest in this fund. One need not time the entry into this fund, because the fund takes care of where are we in the valuation cycle for the market. So I feel it's a low risk category. So anyone having low risk appetite but wants to get into equity as well, I think it's pretty ideal for someone in this fund as well. And what was your second part of the question? I missed that. Yeah.
So, my second part was, as an investor, should I look at it as an absolute return or
Absolute.
a
Yeah.
relative
Okay.
return?
See, generally, I feel it's more of an absolute return product, because, but it may not be that the investment horizon has to be longer. It's not that as soon as you enter, you should expect absolute returns within next 6 months or 1 year. I would say, as an investment horizon, if you are invested for 3 to 5 years, this is what the historical performance has shown, that you are able to generate decent returns on an absolute return basis as well. So the longer the time horizon you have, the higher the probability that you would be able to generate absolute return and a decent level of absolute return. Yeah.
So you mentioned about time horizon and you also mentioned about a decent return. Now, if I have to understand the performance and risk return of this fund over various market cycles, because in last 10 to 15 years, we have seen a good number of market cycles. So if you could help us explain how this fund performed in
Yeah,
those
sure.
cycles.
Sure. So what we have seen is that last 10 years return of this fund is around 12 to 13%. And some analysis of these returns, what we've done internally, and what we figured out is that on a 5 year rolling basis as well, 90% time of the observations, like 90% of the time, the fund has been able to generate on a 5 year rolling basis 8% plus returns. On a 5 year basis, there have been no negative return, rolling return generation by these fund as well. This is the historical track record. Obviously, future may not be the same, but based on the historical performance, what we are seeing. So if someone's invested for like 10 years, your returns can be 13% CAGR on the historical basis is what this fund has delivered. And mind you, Nifty has generated 13% over the last 10 years. And the average equity invested for this fund has been around 52%. So I won't say half the risk, but generally you've reduced your risk substantially, because your net equity exposure during this time horizon has been 52%, and you're able to generate similar returns as what Nifty index, which is a large cap fully invested index, is able to generate. I think that is the superior strength of this product, and which I feel is which reduces the risk but is able to generate almost similar returns as what a fully invested equity product has delivered.
That's a very strong pitch. So you're saying
Yeah,
less risk but higher return or relatively comparable
on a
return?
risk adjusted, yeah, on a risk adjusted basis, surely. And the beauty of this product, similar to what I had spoken earlier, is that, and you asked for instances as well. Like if I look at 2016 as well, it was a good volatile year. And start of the year, there were worries about China hard landing and all that stuff. And that time, equities had corrected, and we had started with around 70% of net equity weightages then. Then during the year, as equity valuations went up, market recovered, we had gone below 50% as net equity. And then again, because of demon in November 2016, markets had corrected. Then again, we had increased our equity levels to about 70%. So this, so 2016 was a very good volatile year, and that's when we were able to harness the entire potential of the product, which is able to deliver. Similarly, in 2020 as well, like before the crash, COVID-led crash, which happened in the market in March 20, the net equity level, if you look at the Jan end portfolio as well, was at around 49-50%. So it was less invested in equity as we entered into the crash. And by March end, it was around 73-74% by March end. So again, it was fully deployed. And by next year March, it had come back to around 40%. So as and when we have these periods of certain shock or certain volatility, it takes advantage and gets fully deployed in terms of the ability of the range, 30-80% range, which the product maneuvers between, and tries to take advantage because the market is cheap and you're able to deploy capital then.
Now, Ihab, when we analyze this fund, there are three pillars which we understand as an investor. One is asset allocation, second is stock selection, and third is fixed income. So out of these three, which one is more important and what is the reason for that?
See, the model has been devised to determine, to take care of the net equity level. So equity is the priority in this fund. We take a main call. The major call which has been taken is the valuation of equity. So I feel in terms of in the classification of asset allocation, stock picking, and fixed income, I think asset allocation is primary, and within that, it is equity valuation which determines the potential return of this fund. And I would place stock selection also equally important, because what we have seen that even if you look through the portfolio of this fund as well over the years, we've taken good active calls, stock level calls in this product as well. So that has also helped us generate alpha in this product. And like I had mentioned in the start of the talk as well, that it's got the best of both the fields, where I try to pitch in terms of the cyclical sectors, a bit of value sectors, the high conviction ideas from that, and Rajat tries to pitch in from the other segment of the market, which is the decent growth or market share gainer companies, and tries to build his high conviction part of the portfolio. So it's complementary in terms of both the styles, and it will have high conviction ideas from both the styles. So stock selection has also generated the returns. I feel model equity derived, the equity level derived or valuation derived model is also important in terms of arriving at the returns of the product. And fixed income, frankly, out here is a tertiary or the balancing allocation which we do, because this being an equity product, we have to maintain 65% at gross level, and it's the balance 35%, which is deployed for fixed income, out of which again we need to keep some money for margin money to take certain derivative positions in the fund as well. But having said that, fixed income has also taken high active calls. There are instances, I remember that during 2020 as well, perps or the perpetual issuance of certain banks had gone up, the yields had gone up a lot. That's when we had built a decent weight in those instruments in this fund as well. So we do take active calls in fixed income as well, but those are like a few calls, but it's predominantly asset led alpha which can be generated, and it's the stock selection led alpha. So
Fair
those are
point.
those are the priorities or the main drivers of alpha. Yeah.
Got it. And here, I would also want to add something for our investors because these days, because of social media, a lot of investors get swayed away by equity and debt allocation in different market cycles. And the representation of those can be because of certain intrinsic interest of people who forward those. But the point here is that even stock selection and fixed income selection is extremely important. So just don't look at the percentage, but also look at the underlying and how they have been selected and what has been the track record of stock picking performance as well as fixed income performance in those funds. So yeah, my next question is that if I look at your fund, you do a daily rebalancing of the portfolio, but there are other fund houses which don't do as frequent a rebalancing as you do. So if you could tell me the pros and cons of your strategy versus others.
See, generally, I think the main advantage or the main reason why we're able to do a daily rebalancing is that the cost associated with rebalancing is pretty low. Like in terms of even if I would say tax incidences of the rebalancing is also low, and we use derivatives as an instrument to rebalance as well. So we use index futures, we use stock futures, we use stock options as well, as covered call has been allowed in few funds. So we use stock options as well. So the cost associated with executing the daily rebalancing is pretty low. So that's one reason why we've preferred daily versus longer duration or longer frequency of rebalancing. And whenever we on a regular basis also we try to test a newer version of the model, but all our back testing has supported a daily rebalancing versus a higher frequency rebalancing. So the back testing has also helped us arrive at the daily rebalancing, and plus I think the cost associated is very low. So one should, if there's an opportunity to, when market is corrected 1-2% and it's opportunity to buy on that particular day, why should I let go of that opportunity? So just because I've set a condition that I have to rebalance at a particular frequency, I shouldn't let go of an opportunity if it is available.
Makes sense. And these days, the incidence of those 1 to 2% moves in market have increased considerably. So I think it
Correct.
makes a lot of sense.
Correct.
So, yeah, thanks to the performance of your fund, today you have an AUM of close to 43,000 crore, which is huge by any benchmark. Now, with this size, how easy or difficult is it to get the agility of daily rebalancing?
So the size is big. I agree to that. But like I mentioned in the earlier question as well, we use a lot of derivatives to arrive at the net equity, and derivative market depth is pretty high. So execution on the derivative levels is on derivative sides or contracts is not that difficult, I would say. And we're using index contracts as well, stocks as well, and futures and options as well. And the second important thing which I feel which has helped the fund scale and which I feel can allow the fund to scale going ahead as well is that the core of the model is a counter cyclical model, which would try to buy when there are sellers in the market, when the market is down, and would sell when there are a lot of buyers in the market and the market is up. So having a counter cyclical approach has helped us also at the fund management level to execute our trades and execute our ideas and high conviction bets. If That's what I feel, a momentum or a pro cyclical model may find it a bit difficult to execute at a scale. But the core being a counter cyclical model has helped us execute, and I still feel the bandwidth or the ability of this fund to scale is higher because of derivatives and a counter cyclical model. These two has helped us scale the fund.
Understood. So you're saying the cost of transaction on a daily basis is hardly anything, plus the impact cost is also very low.
Correct.
And on top of it, there is enough depth in the market, so you don't have any issue on those front.
Correct.
So
Because I would be buying when market is down. So buying should not be a problem. And I would be selling when there is euphoria or when there are buyers on the street. Yeah.
got it. So we have this brings us to the last question of our discussion. So we know you, we know Rajat and Naren as fund managers of this fund, but there would be a team of people who would be supporting you in this decision. So if you could help us understand the research bandwidth of this fund and the team behind the scenes who help you take decisions.
Correct. So from the research perspective, we have a common research pool. So we have around 20-21 research analysts who track around 20 to 25 stocks. So on a console basis, we do have around 450 stocks under coverage. So the research pool is common across funds. There's no specific research resource allocated to a particular fund. So it's a large team, and the coverage is also large, which again helps the fund because of the size at which it is. So we're not restricted in terms of the number of stocks which are covered as a fund house. And we do have one more fund manager associated with us, who is Sri Sharma. She looks after the derivative sides of the fund as well, and helps us execute on a daily basis. Because one thing about this fund is that it's a pretty active fund. Like, there is daily rebalancing, and a lot of derivatives involved as well. So we have a dedicated derivatives person as well to help us support in the in on that front.
So understood, and that's a huge. I would say that's a big team, and that's the reason we are not surprised by the performance of this fund.
Okay.
So, Ihab, this brings us to the end of this discussion, and it was really an insightful discussion where we understood not only the model which you operate, but how you manage that model effectively without having much cost implication or tax implication.
Correct.
Thank you so much for joining in and making our investor aware about your strategy and your fund. And I'm sure our investors would learn a lot from this discussion. Thank you so much.
Yeah. Thank you, Harsh. Thanks.